Hello and welcome to my morning note. Are we at the beginning of a third great dollar bull market? That was the prediction my guest today made a few months ago in the FT, and that was before we saw the recent very strong rise in the dollar against virtually every other currency as the sentiment took hold that the Fed was going to be much tighter, much earlier in the cycle than people had previously thought. If we really are going to see a new dollar bull market, what effect is that going to have on the rest of the world? With me now to discuss this is a good friend of the FT, once more, now an economic consultant, George Magnus. George, thank you very much for joining us once again.
John.
Let's start by taking a look at the dollar trade-weighted index going back to 1980. You can see two very clear bull markets in the early 80s and the late 90s. What drove those bull markets? What makes you think we could be starting another one now?
Well, the first bull market on the right at the beginning of the chart there was really coincided with the anti-inflationary policies we normally associate with Paul Volcker and the Federal Reserve from 1979 to about 1986. And the second one over here that starts roughly around the mid-1990s was the one associated with the technology boom and
The new paradigm.
and all that. So this one here, this is still what I would call a baby bull market.
Yes.
But it's starting, I think, partly because I think the United States is putting some blue water between the financial crisis and its own economic future. It's not assured, but it's better than it is elsewhere. And partly, of course, because of the whole debate about tapering and the Fed now deliberating over how and when to phase out QE.
Okay, if it's about the Fed, could that be negative for other countries?
I think it would be, to the extent that it is actually that we're now seeing a wedge being kind of fattened between the policies and the attitude of the Federal Reserve vis-a-vis, let's say, the Bank of Japan, the Bank of England, the European Central Bank, most other central banks. So that in and of itself, I think, suggests that there's a real interest rate phenomenon to this particular bull market in the dollar, which I think is it's good for investors in some respects, but it's bad for investors in other respects because higher real interest rates obviously are not good for countries that are still struggling to get out of the financial mess after the crisis, and also for emerging countries, of course.
Now let's take a look, therefore, at the biggest emerging country by far, which is China. Plainly has a very big role in the level of the dollar anyway because of the huge foreign exchange reserves it holds. What are the chances that China can manage a true soft landing? Plainly, there is a marked downward trajectory to growth here.
Yes. So this slowdown so far has really been about the decline in exports because of a weakened Western consumer and because of deliberate policy tightening in China to do with containing the risks of a property bubble blow up and so on. But actually, although that's ostensibly what it looks like, underneath it, there is a clear structural slowdown going on. The labour contribution to growth in China has pretty much evaporated. The whole idea of rebalancing, obviously, is to lower the contribution of capital investment, which leaves you with that sort of nerdy economic phenomenon known as total factor productivity, which is the magic of economic growth, which is also about running at half of what it was about 4 or 5 years ago. So I think the problem that China has is actually how far this slowdown in growth is going to go. I think it's going to go a lot further than has already happened so far.
And now let's take a look at the great shock we all received a few weeks ago. These are overnight rates in Shanghai. What was the People's Bank trying to make a point, or is this a point at which the great Chinese credit creation factory begins to break down? What went on there?
Trenchant question. I think they were trying to make a point which fitted in really with a much more sort of frugal political environment embraced by President Xi Jinping, and the ideas expressed by Premier Li Keqiang, which is that there's nothing that the government could or should do about the economic slowdown. But clearly the other problem the Chinese have, which is apart from the slowdown in growth, is this phenomenon of rapid credit creation, rising credit intensity. And I think they were trying to make a point about this, but I think it was mishandled. So as your chart shows, money market rates interbank overnight have come down to pretty much where they were in May. But 2-3 week interest rates are still very elevated, and I think the point about taming this credit genie, I think, is still very, very relevant.
Okay, George, thank you very much again. Okay, I think the lesson we have from this is that we have rather a different world to look forward to, one in which the dollar is getting stronger, and although we don't know exactly to what extent thus far, China is getting weaker.